about the cost of capital, right? Once the cost of capital will be understood, you will be able to make the decisions which are regarding to the capital budgeting. I mean, whatever the future investments we are going to make and how that investment will work. And then we can have the decision about the capital structure. So we starting with the first topic, that is the cost of capital. I think board is visible to all of you. The topic is cost of capital. As we all know, in the present scenario, when the funds required to start up a business are huge, so the companies are not going to be dependent only on equity. So for this, the capital is divided into different categories. The major category part is the equity share capital, the preference share capital, and then we have debt, source of financing. These are the major sources of finance which are used by the companies, and one more is that is an addition to equity, that is known as retained earning. So these are the four major sources of finance for any organization, but these sources are not free of cost. When we talk about resources, it means something or other thing the company has to pay in return for having that fund from the other person. So whenever the person who is making investment known to be the investor, that person must have certain kind of expectations from the money he or she is investing in any organization. So that return which the other person expects as an investor is known as cost of capital for the company's point of view. It is the cost that company has to incur to generate that capital for the purpose of diversification, or you can say for the purpose of growth and various functions to be performed without any problem of the funds. So this cost of capital is divided into four different parts. We will study the cost of equity, which is termed as to be the ownership rights, right? The equity shareholders are termed to be the owner of the company because they have the voting rights, they have the other rights which are not available with the other resources. Then we have preference share also, which are there, but they are issued with fixed coupon rate. This coupon rate means the rate of dividend that is to be paid to the preference shareholders has been predefined. Then we have debt source of financing, in which the funds has been raised in the terms of loan from the outside world, from the outsiders. And then we have retained earning. It is that part of the profit which is not distributed by the company in terms of dividend to the equity shareholders. For example, if we have 100 rupees profit left with company, and out of this 100, rather than giving the whole amount to the equity shareholders, if company decided to retain 20%, it means 20 rupees will be used by the company for further investment, and only out of the 80 rupees the distribution will be made among the equity shareholders. What its impact is, whenever we have to decide about any kind of investment, which you will study under the heading of capital budgeting. When we talk about capital budgeting, what we have to see, we will make investment only in those assets where our revenue generation, or you can say the cost of earning, is more than the cost of capital. That is the point where the decision will be taken. So it plays an important role. Number two, it also helps in computing the ideal capital structure for the organization. What capital structure mix has to be used by the organization, that also depend upon the cost of capital. So the management's performance will also be adjudged by the investors or the prospective investors on the point of view, are the company in a position to pay the return which is expected by the shareholders or the prospective shareholders at present scenario or not. So this is how the things will be moving in the chapter of cost of capital. Then when we talk about this cost of capital, now we will bifurcate it into the four parts. So the starting with the first part is the cost of debt, because it is an outsider fund which is a liability for a company. When you are paying debt, Most of the time we use the term debentures. It's a liability for the organization, and debentures are categorized into two parts on the basis of cost of capital computation. One is called redeemable debentures, redeemable debt, and the other is known as irredeemable debt or perpetual कह सकते हो. You can call it a perpetual also. Mean there is no time limit to repay this. But if it is a redeemable one, we know that after a span of particular time, which is a fixed one, the company has to repay the amount which is due on such type of debentures. The best benefit of debentures is that if whatever interest is paid on debentures is eligible for tax deduction. You are aware that whenever we are making profit and loss account or we are preparing profit and loss account of an organization, we used to show interest on the debit side. It means whatever the tax liability the company has to pay, out of that tax liability, we have a benefit that this interest will be deducted, and whatever income left after paying interest to the debenture holders, that will be put to tax. So this will help us in our planning of taxes also. So when we get is being considered, the other thing important is the interest rate on debentures or on debt is coupon rate. It is known as to be coupon rate, which is predetermined, keeping in mind what rate of interest is applicable in the present scenario. Whatever rate is applicable, that is taken into consideration for the paying the debt interest. So we have to compute the cost of debt. The first thing. Cost of debt. We usually denote cost with the K and D for debt, cost of debt. The formulation what we are going to use here will be interest I whole upon the net proceeds. Interest upon net proceeds. Whenever you are going to calculate the interest, it means it is always calculated on the face value. Keep this thing in mind. Interest is computed on face value. And net proceeds is the amount we are going to realize on the issue of that debentures. What this net proceeds is, net proceeds means the price of debt at which we are going to issue it in the market minus if we are incurring any kind of cost for the issuing of the same, that is cost of issuance or the cost of issue of debentures, that will be deducted. एक तो ये point है. If the debentures are issued as face value, what if debentures are issued at premium? Premium is the price where debentures are issued at some face value plus certain amount of the premium for the organization reputation. So in that case, the net proceeds will be equal to the face value plus amount of premium, if any, and minus cost of issuance. On the other hand, if debentures are issued at discount, mean at a price lower than the face value, in that case the net proceeds will be the face value minus discount and minus cost of flotation भी बोल सकते हो आप, cost of issuance भी बोल सकते हो. Cost of issue of debentures is to be deducted. So these will be termed as net proceeds in different cases. This cost, what we have calculated using this formula, is your cost of debt before taxes. So I'm using the term KDB, cost of debt before taxes, because we haven't computed taxes yet. Is it clear to everyone? Any query, any question?
Clear, ma'am.
Okay. If this is the cost of debt before taxes, and we used to go for the cost of debt after taxes, because it is paid before the income tax paid by the company. So we will calculate it. You can use the formula cost of debt before taxes into 1 minus T. This T stands for your tax rate. This T stands for your tax rate. This is the formula we are going to use when we are talking about irredeemable or perpetual debentures in the market, right? Now the second part of this is if the company has specified at the time of issue that we are going to repay the liability within a stipulated time, maybe 5 years, maybe 7 years, maybe 10 years, depending upon the performance of the organization and the decision by the management. In that case, this formula will not be used. Now they are redeemable, means we have a stipulated time to pay off the liabilities. In that case, cost of debt is equal to, simple formulation is I stands for interest plus 1 by n, that is the number of years which is taken into consideration for the purpose of repayment of debentures, into. Here we have to talk about the two values. One is the value which is redeemable. We can say redeemable value, the value which we have to pay at the end of the time, minus net proceeds. Net proceeds is again the same. If discount is there, deduct it from the face value. If it is at par, then take it as a face value, or if it is at discount, deduct the same. Whole is to be divided by. This whole is to be divided by. We can use the formula this 1 by 2, whatever the redeemable proceeds and the difference with the, here we take the average of the two. Redeemable value plus net proceeds divided by 2. Again, this is a formula before taxes. It is a formula for before taxes. If we put after taxes, when we are going to for the after taxes, then what we have to do? Interest into 1 minus tax rate. First, out of the interest, we will deduct the tax plus 1 by n into redeemable value minus net proceeds. Whole is to be divided by the average of redeemable value and net proceeds. Right? I is always the interest. Yes, somebody asked in the question, can we write? Yes, we can write if we directly call cost of debt after taxes and it is a perpetual one, then you can directly use this formula. I into net proceeds 1 minus tax rate. Both the formulations can be used. This is for redeemable one and this is for irredeemable. Shall we go for some practical of it? Right?
Yes, ma'am.
Please mute yourself. The question we are going to solve is for this, because this is the lengthy one, other one is the simple formulation, right? So what question we are going to solve? A company has issued 5-year debentures 5 years के लिए the companies has issued a debentures for which for the market price, the market value rupees 50. For the market value rupees 50 and coupon rate of interest is 10%. Coupon rate of interest is 10% and debentures are redeemable at par. Debentures are just redeemable at par. So we are going to use this formula. For calculation purpose, we can assume that the tax rate applicable, we can assume at the rate of 50%. So that the calculation can be easy. So this is the formula. This is the thing given. First we need interest. Interest is 10% of the market value. Right? Check in one thing. Here the debentures are redeemable at par or the face value जिस पे हमने market में issue किया that is also 50. Means this difference will be of no use for us. Because the market value and the redemption value both are equal. So what we have to consider is interest is 5, 10% of 50, 1 minus 50% tax plus 1 by 5 is the number of years and maturity value is equal to net proceeds. Whole is to be divided by 1 by 2, maturity value and net proceeds average. You can calculate the cost of debt here. You can calculate cost of debt.
5%, ma'am.
5%?
Yes, ma'am.
Because there is nothing to be calculated. Check कर लीजिए. And other people have calculated?
Ma'am, 5%.
5%. It will be coming to 5%. This was the simple chunk question to be solved. Now we take when there is a difference between the maturity value and the net proceeds. We are writing down another question. For that, we talk about कि a company has issued 5-year debentures that can be sold in the market at a price of 96.50. 96.50. A company has issued a debentures for this price. Number of debentures जो हैं, that is 100. Number of debentures that we are going to issue is 100. Number of debentures at rupees 100. Issued at a value of 96 rupees and 50 paisa. Can I dictate the equation or the question to few people? That will be easy to solve.
Yes, ma'am.
Yeah, please write it down then.
Key point दे दीजिए मैम हो जाए.
Key points से कर लोगे? Will that be easy?
Yes, ma'am. Face value, market price, redeemable value,
Yeah.
coupon rate.
Okay. This is the price at which we have issued the debentures. This is the face value of the debentures, right? Then the coupon rate of debenture is 5%. Coupon rate of the debenture is 5%. Maturity is 5 years. Maturity is 5 years. The tax rate is 40%. Tax rate is 40%. Debentures are redeemable at par value. Debentures are redeemable at par value. Calculate the cost of debt. What will be the cost of such debts?
3.77%.
3.77%. Is it correct? 3.77? Wait, let the others solve. You just have to compute the coupon rate, that is 5% of 100 rupees. That would be 5, right? Then what is the tax rate? 1 minus 40% into the maturity is 5 years, 1 by 5 into debentures are redeemable at par, that is 100 minus 96.50, that is the net proceed, divided by 100 plus 96.50 upon 2. That's it. Are you getting the answer of 3.77% or not?
Yes, ma'am, सही है.
Ma'am, 3.77.
You took time, but it's okay. 3.77 is the correct answer. This is how we calculate the cost of debentures if they are redeemable. Now, we discussing about the second part. Second part is if we talk about the second method of financing or the capital, that is the preference shares. Second is cost of preference shares. You remember one thing which we usually use when we calculate the cost of capital structure mix calculation or other, that there is earning before interest and taxes. We usually deduct interest on the first part, right? Then we are left with interest, earning before taxes, EBT, and out of this we usually deduct the taxes we have to pay. Then we are having PAT, profit after taxes. This is the equation how we work. EBIT, interest is to be deducted at the first hand, then we have to take into consideration the taxes, then we are left with the profit after taxes, that is the PAT. Out of this profit after taxes, the first thing which is the liability of the organization to be paid is the cost of preference shares, because they are given preference ahead of the equity in the both the payments, whether it is a payment of dividend or it is the payment of the capital at the end when the company went into a liquidation. So in the PAT, the first deduction will be of preference dividend. So already taxes has been paid. Taxes has already been paid. So whatever the preference dividend we are going to pay, it is after tax. So there is no formulation for preference that we have to compute it after tax. It is understood that it is paid after the payment of the taxes. So again in the preference also we have two parts. One, when the preference is redeemable, and another the preference is irredeemable. If we are talking about irredeemable preference shares, then we have a simple calculation. On shares, company used to pay dividend, not interest. Interest is paid only on loans. Debt pay interest, and on the preference shares, we are going to pay the dividend. This dividend is to be divided with net proceeds. Net proceeds again with the same meaning. If it is par, it is the face value. If it is at a premium, then face value plus premium, and if it is at a discount, then face value minus that amount of discount, and deduction of any kind of cost of flotation, whatever we have incurred to issue those preference shares in the market. So we will denote it as KP, cost of preference, or the short form can be written as D upon NP. This is a simple formula for irredeemable preference shares, which are not going to be redeemed in a given period of time. Now the second category is redeemable preference shares. Now they have to be paid within a fixed time which has been given by the organization of the company at the time of the issue. So the cost of preference in that case will be just similar to the cost of debt, except the part of it, taxes. Cost of preference will be equal to dividend plus 1 by n maturity value minus net proceeds, whole is to be divided by the average of maturity value and net proceeds. This is just similar to that. Here we use the term interest, and out of that interest I deducted tax rate. But now it is the similar one. We have to use the SIG. Fine? Any question?
No, ma'am.
Okay.
No,
We can
ma'am.
start practical with it.
Yes, ma'am.
Yes, ma'am.
Let's suppose a company has issued 10,000 preference shares. 10,000, 10% preference share. These are issued by a company, right? We have to compute the cost. If the cost of issue is given, cost of issue is ₹2 per share. Cost of issue जो है that is given ₹2 per share if shares are issued at. We have the three conditions. So we take it as a premium. कि shares are issued at premium of 10%. Premium of 10%. Right? When question is silent about the face value, always take it as 100. Face value is ₹100. Face value is ₹100. और आपका जो redemption है, redemption period is 5 years. Redemption period is 5 years.
Redeemable value, ma'am.
If nothing
Redeemable.
is mentioned, it means it is at a face value.
Redemption also face value.
Yeah, there will be no fluctuation in it.
Ma'am, what is the dividend rate?
Preference shares define itself. 10%. 10% preference shares.
10.51%.
10.51%.
51%.
$7.78, ma'am.
There is a variation in answers.
7.78.
7.78. Okay, fine. I'm just writing it down. We will solve it. Don't worry. I'm asking single thing. You just answer that. What is the dividend on the total shares that we have issued?
मैम आई हैव क्वेश्चन. मैम प्रीमियम का रेट क्या है? It's 5% or it's not visible actually.
10% dividend. It's 10%, Shikha.
Okay, we have to calculate 10% premium first, no, ma'am?
Yeah. What I have
Okay.
written is, I'm repeating, the face value is 100 rupees. We have issued 10,000 preference shares, which are having 10% coupon rate. Cost of issue is rupees 2 per share issued. If the shares are issued at a premium of 10% and redeemable after 5 years, what will be the cost of preference? This is the
Okay,
exact.
thank you, ma'am. Thank you
Okay.
so much.
8.17.
Yes, ma'am. 8.08 है मैम.
8.08.
Yes, ma'am.
Ejaz, you have given two answers, right?
Ma'am,
मैम
8.08.
एवरेज करना भूल गया था मैम. एवरेज करना
8.08.
भूल गया. 8.08.
Okay. For others' knowledge, could you please explain what we have to write down right now in the formula of cost of preference is equal to how much I have to write the amount of the dividend? Tell me the amount of the dividend. What will be the dividend? I have to write it down.
10.
10 rupees, ma'am.
Plus. After 5 years, right?
Yes, ma'am.
Redemption value
100.
100.
net proceeds
Minus 108.
108.
100.
now calculate. Now it is down 8.08.
8.08.
Then we move to the third part, the cost of capital. The third topic is cost of equity shares or equity capital. You know very well that equity is the shareholders who have a right, voting right, and they have a right to appoint the directors of the company. So they termed as to be the owner of the company. But even then, they are the owner of the company, equity shareholders. This is not free cost of capital. It's not free of cost, right? It is not a free capital. Still, we have to pay something to the equity shareholders, keeping in mind that what return is available to them after making payment to the preference shareholders, as we discussed before that. After paying the preference dividend, if profit still left with the company, then its company has to pay that amount to the equity shareholders. So in equity, the rate, coupon rate or the rate of dividend is not predefined. It varies, right? If the company is performing very well, they can make more payment to the dividend as a dividend to the equity shareholders. Automatically, the price in the equity shareholder in the stock market will go up. If they have losing or they are not paying them well, they may have a prospective shareholders who are not ready to make the investment. So never ever take it as a free capital. But when we compute the cost of equity, rather than dragging it into the one point, we always calculate using the different formulation. The first formulation that we use for the computation of cost of equity is known as price ratio method. Price ratio method. This is one name, right? ये price ratio मैंने इसलिए लिखा है because this price is to be compared with the dividend, right? this price is to be compared with the dividend. So we can call it dividend yield method or ratio, whatever term you want to use. It is known as dividend yield method. According to this method, what we have to calculate is that cost of equity will be determined on the basis of whatever dividend company is paying to the equity shareholders, that is to be compared with the price, that is the net proceeds. Same formulation, discount minus premium add, cost minus, right? So dividend upon net proceeds is the first formulation when we use dividend yield method as a method to compute the cost of equity. Or the basic assumption of using this method, there is an assumption for this. That is to be kept in mind. There is one basic assumption while using this method is that the investors give importance to the dividend and risk in the firm. वो assume क्या करते हैं कि the risk which is involved in the business is not much. It is kept aside. Though risk of the firm remain unchanged and the dividend is given prime importance to make the investment. This is the first formulation. Then if we know the companies are performing year to year, so there are the chances that company grows. Maybe due to diversification, maybe due to research and development, maybe due to innovations, the companies are keep on growing. Sometimes their growth rate is variant, meaning it varies from year to year, and sometimes their growth is fixed. So now we have to consider both type of growth, whether it is a consistent growth which will be fixed for the coming years, or the growth is keep on changing. That will also have an impact on your dividend. So the first formulation that we are going to use, when the dividend, or we can say the growth, what I am using the term is growth rate is constant. We assume that whatever growth has to take place in the dividend, that will remain constant. There will be no change. Then the cost of equity will be D1. I'm not using the term D, I'm using the term D1. This is the latest dividend after addition, you can say, right? Divided by net proceeds, which was there in the older formula also, but I will make an addition to it. That addition is of growth rate, which I have assumed is to be the constant. This will be the formula. D1, I can break it down like this, that D1 is equal to dividend which is paid in past into 1 plus growth rate. Dividend that we have paid in past into 1 plus growth rate, and that dividend we have used here to compute the cost of equity. We are going to solve a sum relating to this. What company is having? That company is planning to share 1000 equity shares, a number of shares. The company is going to decide that they are going to issue 1000 equity shares in the market, right, at par value of rupees 100 each. Par value of rupees 100 each. Cost of flotation is 5%. Cost of flotation is 5% of the share price, and company in the initial stages paying a dividend of rupees 10 per share. Initial dividend is rupees 10 per share, whatever we are issuing at this point. And what company is expecting? That there will be a growth rate 5%. They expected that there will be a growth at the rate of 5%. So if we have to calculate the value of equity in this question, what will be that?
%16.05.
Growth rate is there. We are given the dividend of the past. Initial stage. Initial hai, we are going to issue this. So our initial dividend is 10.
To increase by 5%.
11.63%.
Increase will take place in the later stages. Initial dividend, that's why I use the term initial dividend. When for the first time company is issuing its equity, they start with the dividend of 10 rupees only. They are not going to make an addition. But after that, there is a continuous addition of 5% into the dividend. So you are not going to add this 5% right now. Ijaz, am I clear? So initial stages mein what is the dividend we are going to pay? It will remain 10. No change. And what is the net proceeds of this question? 95, I think.
95.
95. And the growth rate is 5%.
Right.
And the growth rate is 5%. So what will be the computation of this?
15.553.
15.53. Because if I haven't used the term initial, then what you have to do? Then you have to go for 10 into 1 plus 5%, that is a growth rate, divided by 95% plus 5%.
16.05.
16.05. So this is the difference. I think I made clear to everyone?
Yes, ma'am.
So these are the two basic formulations. Third formulation which we are applying. The third is the scenario which we are using right now, that is earning yield method. When we talk about the earnings, now the cost of equity will be EPS. EPS here stands for earning per share divided by either the net proceeds or the market value, whichever is given in the question. Market price bhi le sakte ho, you can also take the net proceeds as per the availability in the questions. So this calculation of EPS, I'm moving to the last part. We start with earning before interest and taxes. Out of this, we first deduct the interest which we pay to the debt or the debentures. ये हमारे पास आ जाएगा earning before taxes, and out of this we will deduct the taxes amount. So it will be known as PAT, profit after taxes. Out of this, we pay preference dividend. So this will left out balance is known as earning available for equity shareholders. This is the earning available for equity shareholders. And when you divide this earning available for equity shareholders with the number of equity shares, this will be termed as EPS, earning per share. And this earning per share is to be compared with either the market price or the net value, whatever is given in the question. It will tell us the exact amount, how much cost of equity the company is incurring. Got this?
Okay, ma'am. Okay.
Yes, ma'am.
Then, the extension of the equity. That is the fourth source of finance. That is known as retained earnings. That is known as retained earnings. In journal, you will find कि whatever the cost of equity, that is the cost of retained earnings. In general, because it is that part of the dividend which is not paid to the equity shareholders, but it is kept for the further processing in the business, or you can say for diversification process or the growth. So the cost of the two will be considered to be the equal one, right? But if again the same growth and all that concept been taken into consideration, then in that case you will put the same formula that whatever there is growth in the dividend has taken place, and whatever be the market price of the equity in the open market at the present scenario, we just add growth to it, as we have already done, right? This is what the part we have already discussed. So these are the four basic points of cost of capital. But when we are making decision, we used to consider total cost of capital. Either we can say it is an average cost of capital, or in certain points also when we calculate some things average, we also go for the weighted average cost of capital also. So we are calculating both the things, how the average cost of capital can be computed and how the weighted average cost can be computed using in the formulations what we have discussed today. If we talk about the weighted cost, it's just a statistical formulation. When we have to compute the cost, which is the weighted one, so the first formulation is what we use is the summation of x w divided by the summation of w, where this w stands for weight and this x stands for specific cost of the source of fund. This x is specific cost of capital. Now, for this proportion, we are moving with this small question, practical, what we can use. For example, a company is having different sources. These are the funding sources available with the company, which is divided into four parts. We are using all the four. One is the form of debentures. Then we have preference shares. Then we have equity. And last we have retained earnings. Retained earnings. I'm using all the four sources. Right? Whatever amount they will put up with this is that their company is using for 15 lakh rupees out of the total capital. Company has an issue of 12 lakh rupees for preference shares. Then it has an issue of 18 lakhs for equity. And for the last one, that is the retained earning, it has 15 lakhs. So get the total of the same, how much total amount of the capital is invested in the business. The total amount invested in the business is, make a total of all the four items.
60 lakhs.
60 lakhs. Right? So if this 60 lakh is given, can we in a position to calculate the proportions?
Yes.
Can we
0.25.
calculate the proportion? Or I can say the weights. How much we are using?
0.25.
In percentage. Exact percentage 25%. 50 lakh divided by 60 lakh into 100 अगर करिएगा तो कितना परसेंट हो जाएगा यार बताओ
25, 20, 30,
25
20%, 20, 30,
30
30.
and then we have 25%. You must know that the weight of the total proportion should always be 100. Now what we have to consider here? If I say that the preference shares are 10% preference shares, right? And the debentures are 5% that after taxes. So your cost will be 5% because it is after taxes. Preferences 10% because nothing variation is given, and then it has given itself that the cost of equity has been determined to be 12%. I have told you just before this that whenever the cost of equity is given and nothing is given relating to the cost of retained earning, then our assumption will always be that whatever the cost of equity is, that will be applicable for the retained earning. So here retained earnings cost will be 12%. Yes. Equity and retained earnings are measured on the same yardstick. If nothing differentiating will be given and question is silent about the retained earning, then we can also assume it at 12%. Now please compute WX and then the cost of weighted average cost for all the things. Multiply these two things together. Keep on multiplying. $1.25 for the first, second, 20 into 10, 2.
3.63.
No. How the 3? Where about individual calculation? Are you talking about individual calculations?
Yes, ma'am.
Acha, yes. Okay. Multiply this. 25 into 5% will be equal to
1.25. Individual.
individual. 20 into 10% is 2.
3.63.
3.6. And in the
And
last,
3.
only 3.
And finally 9.85.
The total is 9.85. This is your weighted average cost of capital. So wherever we are going to make the investment, we have to keep in our mind that at least a return of more than 9.85 we have to earn from that investment. Only then we are going to make the investment. Because your net proceeds earned should always be greater than the net proceeds you are going to pay.
मैम
Yes.
मैम इसमें इक्विटी 12%, ये मुझे समझ नहीं आया.
I have assumed, Shalini, again it was not given, otherwise we have to calculate it individually. So I don't want to make it a lengthy question, so it is there, it is given 12%. Okay?
Okay.
Any other question from anyone? Yes? Anyone, anything?
No, ma'am.
Then next we will be moving with the same type of thing. We will just compute the weighted average cost when the cost is to be calculated individually. It was not given in the question itself. Shall we do the one question like that so that we have a revision of all the topics we have covered right now? Yes, class, you have to solve it. Please answer.
Yes, मैम. मैम एक क्वेश्चन जो आपने कराया हुआ था ग्रोथ पर, वो वाला थोड़ा क्लियर नहीं हुआ मुझे.
अच्छा, मैं अभी बताता हूँ. 1 सेकंड के लिए. 1 सेकंड का टाइम मुझे, जो मैंने आपको ग्रोथ वाला बताया है वो बताओ. Is it the question solution which you wouldn't understood, Shalini?
मैम वो ग्रोथ परसेंट वाला क्लियर नहीं हो रहा पॉइंट.
Okay. Cost of equity when we are given dividend upon net proceeds. This was the formula where I have used the term D1. This D1 denotes the dividend after growth. The growth has been given or that dividend has been impacted by the same, and then we added the overall growth. For example, if I say in the past company is paying a dividend of rupees 10 to the shareholders, and now company is having a growth rate of 1% or 5%, anything we can assume. Let it be the growth of 5% is expected in the company, and it is a fixed rate of growth, it will not fluctuate. Now when you are calculating the cost of equity, here we will put 10 into 1 plus 5%, the growth in the dividend, it will be becoming D1 divided by, let the net proceeds of the share is 100, multiplied by to karoge, plus growth rate which is given 5%. Shalini, this is the growth for the dividend. This is the growth in the overall organization. So the both growth has to be taken into account and it will be added to this. Hope you get it.
Okay, ma'am.
So when we are going to compute all the four together, what we have, I try to make question less lengthier for you people. So I'm giving you certain information which is to be calculated in the question. This is the information provided. Equity, then we have preference capital, then we have debt, and last we have retained earning. When we talk about equity, it is used, the calculation is in millions, okay? But I'm not putting all the zeros, so I'm using just the short form. What they say, the company has issued 10 million shares at rupees 10 each. At rupees 10 each, so it will become 100. Preference share is 11% preference shares. 11% preference shares में division is 1 lakh shares. Number of preference shares is 1 lakh. And the total amount is 10 million. 10 million because the price will be 100. Then we have debentures. The debt. Debt is given 13.5%. Debt rate is given 13.5%. Again, 5 lakh debentures at rupees 100 each, issued at par, so the total comes to 50. And the retained earnings are given 120 million. 120 million. Make a total of it. Except, wait. Except debt, we have certain kind of loans also. Some category of loans is also provided in the terms of term loans. These are the term loans at the rate of, these terms loans are at the rate of 12% and amounting to 80 million. So what is the total capital of the company? What is the total fund requirement we have calculated from this? Make a total of it.
270.
270, ma'am.
Please have a look properly.
270.
100 plus 10, 110 plus 50, 160 plus 200.
360.
Total will be 360. Equity is 100 million. I repeat, check it out. Preference
बोर्ड
is
पर लाइट आ
million.
रही तो शो नहीं हो रहा क्लियरली.
अच्छा.
Clear नहीं है.
Is it visible now?
Yes, ma'am. Yes, ma'am. Right.
Thank you, ma'am.
Okay, please note it down, please. Shall I give you the additional information? You have noted all this now. Now put up the additional information.
Yes.
Additional information. Number 1. Next expected dividend then. Next expected dividend rate of 7%. It is expected to grow at a rate of 7%. Market value per share is rupees 20. Market value per share is rupees 20. Preference shares are redeemable. Preference shares are redeemable after 10 years. Preference shares are redeemable after 10 years. Right? After 10 years. Currently selling at rupees 75 per share. Currently selling at rupees 75 per share. 4 point. Then the 5th point is debentures are redeemable. Debentures are redeemable after 6 years. Debentures are redeemable after 6 years and selling price is rupees 80 per debenture. Selling for 80 rupees per debenture. Tax 50%. Tax is assumed to be 50%. Now we have to compute the cost of every element of the capital. Cost of every element of the capital. Go one by one with one thing. You start with what?
Okay.
We start with equity or we start with debt exactly or what? Debt, equity, preference, retained earning, cost of equity, cost of retained. What you are going to compute first? Take only one, no? Tell me what you want to consider first.
Ma'am, debt.
Shall we start with the debt?
Yes, ma'am.
Okay. Write down cost of debt. Cost of debt equal to cost of debt is equal to, what is the dividend rate? Sorry, what is the cost of debt rate given in the interest form? 13.5. Shall I rub this? Have you noted it?
Yes, ma'am.
Okay, first we are going to calculate cost of debt after taxes. So the coupon rate of interest on the debt is given 13.5 at face value. Tax rate is 50%. Tax rate is given 50% plus. How much time it will take to redeem the debentures?
100 rupees at par.
Time.
6 years.
6 years. And the selling price of the debentures is
80 rupees.
80.
80 rupees. But when we have to pay the loan, that we have to pay at the full value?
Yes,
Right?
ma'am.
100 minus 80 will be our net proceeds divided by the average of 100 plus 80. Maturity value will be 100, net proceeds will be 80. Yes, computed, how much it will be?
11.20.
11.20%. This is our cost of debt. Calculated by everyone?
Yes, ma'am.
Then moving to next. If you have debt calculation, then go for the loans also, because that is also a loan, is also a like debentures. They will be treated in the same manner. Likhe, cost of term loans. Cost of term loans will be very simple.
6%.
It will be 6%.
6%.
12% is the rate of interest we are going to pay. 50% the tax we are going to deduct. So it is directly calculated at 6%. Two fan, we have completed the 2 points. Number 3, third page only. Preference. Shall we go with the preference now?
Yes, ma'am.
Cost of preference shares is equal to. Yes, preference is also redeemable, I think.
Yes, ma'am.
Preference shares are redeemable.
Yes, ma'am.
After 10 years.
11% was the rate of dividend. 11% preference shares were there. So they are redeemable after 10 years. What about their selling price?
75.
75. So it means we have to calculate 100 minus 75 divided by 1 by 2 into 100 plus 75. This will be the cost of preference.
15.88.
15.88.
88.
Then
गलत
comes
है गलत है मैम
2.5. 13.5 divided by 175. एक बार और calculate करो. 13.5 divided by 87.5.
10% मैम 15.88%.
15.88 आ रहा है. Are you sure?
Yes, ma'am. $15.43. Sorry, ma'am.
तब मैंने 2 बार बोला है कि there is certain mistake क्योंकि वो rate उतना नहीं बन रहा है. Divided by 87.5 is coming to 15.43.
43.
Now, cost of equity. Cost of equity is equal to. Yes. What was the dividend given in the expected to be given in the next years?
1.5. 1.5.
1
D1.
point. It means 1.5 is our D1 divided by what is the
20.
market value?
20.
20 plus how
7%.
much is the growth rate? 7%.
14.5%.
What will be the cost?
14.5%.
1.5 divided by 20 into 100 plus 7%, the total comes to 14.5%. This is our cost of equity. Now we are left with only last one. We have certain kind of retained earnings also.
Same.
Is there retained earnings or not?
Yes, ma'am.
Yes, ma'am.
Okay. When the cost of retained earning we have to compute. Is any information provided for cost of retained earnings?
No, no, ma'am.
No. So then what we will
15.
calculate?
K.
KR is equal to KE, which is equal to
14.5%.
14.5%. We will take it also 14.5%. Is it noted, everyone?
Yes, ma'am.
Yes, ma'am.
Okay, if it is calculated or it is noted by all of you, now I'm taking it out and we are talking about the proportions, mean the weights. Now we talk about weights. Yes. Weight, here the source of capital, here it's individual cost, then we calculate WX. First, what was the first given in the question? Equity?
Yes, ma'am.
Yes, ma'am.
Yes, equity. Yes, can you tell me what was the weight of equity? We have invested 100 million out of 360 million. So what will be the weight of equity only?
79.
27.7.
20?
27.9.
7.78.
27.78.
78.
What was the cost of equity you have computed just now?
14.5.
14.5. Then what was next given?
Preference.
Preference.
2.79.
Okay, 2.79. What was the cost of preference?
15.43.
15.4. What was the third one?
Debenture.
Ventures.
Debentures.
13.89.
13.89. Cost?
11.20.
13.89. 11.40
11.20.
Okay. Fine. Then debentures के बाद?
Retained earnings.
Retained earning.
33.33.
This way. Retained earning 13 point.
33.33.
अच्छा 33. Fine. 14.50.
Yes, ma'am. Loan का 22.22.
Term loan
22.22.
22.22. And
मैम
term loan I think 6%.
यस मैम मैम इक्विटी वाले में मैम 27.79 कर देंगे तो मैम 100 हो जाएगा
कहाँ पे?
मैम इक्विटी वाले में 27.79
Okay, okay. To make it 100, right?
यस यस मैम
Okay, okay, okay. Fine. Thank you. Yes. Multiply the weights with the x. please multiply each and every and then calculate.
12.8%. Final.
You're telling the final answer or you're just multiplying these two?
Final answer, ma'am, 12.28.
Total बता रहे 12.28.
28.
एक बार check.
Approximate round off हो जाएगा मैम उस लगभग
12.2. चलो we will check.
This is
Check करिए please. Go ahead with it.
1.5560.
5 point.
1.5560. अच्छा वैल्यू आपने निकाला है 154. 4.832. 1.332.
देखो कितना आ रहा है around 12.18 or 12.20 approximate. Check everybody please.
Okay. 12.1802. 12.1802. 1802.
That's 180. We will just talk about the first two decimals. 12.18 will be okay. Is the topic clear to everyone?
Yes, ma'am.
Any doubt to anyone about it?
No, ma'am.
No, ma'am.
Okay. Okay, thank you. If there is no doubt, so this is the topic for today. Now from tomorrow, I will take up with the capital structure. Second part of this will be the capital structure. We have discussed about the different elements of capital. We discussed about their cost. Now we have to decide how the capital mix structure is based on methods of the model.
Thank you, ma'am.
Thank you, ma'am.